And so we're going to pick up where we left off on chapter 3 by reacquainting ourselves, first off, the difference between travel and transportation, and secondly, just doing an example on travel. So did anybody catch the difference between travel and transportation from the Pittsburgh lecture?
Well, the other thing I was just a little bit confused about the costs, or I mean expenses and costs seem like the same thing.
Expenses and costs are the same thing,
Okay.
essentially.
Like, yes,
So the question is
Let's
the
go.
difference between costs and expenses, and those, although they're not actually theoretically the exact same thing, they're used interchangeably in terms.
yeah, 'cause I mean, like on one it said tips and lodging, and then on the other one there wasn't, so then.
Okay, let's start with the difference between travel and transportation. Transportation costs are those costs that are write-offs, or those expenses that are write-offs when you're not leaving your tax home. So, and I gave the example of like when my son travels from one job site to the other for work, he goes across the Bay Bridge, it's $8 every time you cross it. That's a write-off for him. It's in the course of his daily, it's when you don't leave your tax home. Transportation costs, and it can be, rail, plane, car, tolls, parking, anything like that. Whereas travel is when you leave your tax home. Then with travel, we talked about 3 different things, and this is all on the slides, you don't need to write all this down, but on the travel, we talked about, are you going in the U.S. primarily for pleasure? Are you going in the U.S. primarily for business? Or are you going out of the country? Those are the 3 categories. And it's different for each category. So let's take a look at this one. And then back to transportation, you can either take actual or standard mileage.
Yeah, well, I understood that. I just meant like there was a couple slides back then.
Do you know which slide?
Probably just a couple of them.
So that went from transportation to travel.
Wait, go back again towards the end.
Tell you what, I'll keep lecturing and then you can find the slide that you have the question on. Okay, so in this example, Gretchen is the sustainability director. She's traveling from Idaho to New Mexico. So obviously she's not leaving the country. And she paid $380 for airfare. She spends $330 on lodging, $150 on meals for the business portion of the trip. While she's there, she goes on a sightseeing trip of the Turquoise Trail. And she spends $400 on car rental and lodging and $85 on meals. So what does she all get to write off? What's her total deduction for travel? Does she have to allocate the airfare? No. Would she have to allocate the airfare if she's going out of the country? Yes. So she gets the whole $380. She gets the $330. What about the meals?
50%?
Yeah, 50% of the meals. None of the personal expenses. So her total deduction is $785. Okay. So the point here is you don't have to allocate airfare if you're within the country. You don't get any of your personal travel, and you get 50% of meals and entertainment. Okay, per diem. Per diem happens, I've got a couple clients that do this, when you travel a lot for work and you don't want to save all your receipts. It's just too much. Some people are never going to do that, bottom line. So they give me the dates they traveled and where they traveled. They keep a log of that. And then I choose, well, I don't always have a choice. There's 3 methods. There's the regular method, the high-low method, and then the next one, I'll just show you the titles and then I'll talk about each of them. And then the next one is M&IE, meals and incidental expenses. You have to use this one. Where is that? Oh, right here. You have to use this if you're self-employed. So like my gal that's a weaver, and travels around to a bunch of trade shows with her weavings, if she uses per diem, which she does, she's got to use meals and incidental expenses. And what that method says is you have to use, you use actual lodging, so you still got to hold on to some receipts. And then for the meals and everything else, you're either in a high area or a low area. And if you're in a high priced area, it's $66 a day. If it's 41, it's low. But you only get half those numbers because it's a 50%. So when she travels, for example, she gives me a log, and it will say, oh, and the high and low methods, by the way, are published. The IRS publishes them. So she'll say, you know, from
Maybe if you tried Xing out, getting back in like you did last time, it would.
See, it does say not responding. Huh. Yeah, it keeps going into this flow, doesn't it? Never mind. So when she gives me all of her data, I've got to, I just got to go look up, is it high or low? I mean, I know where she travels. I know Portland's high. I know San Francisco's high. I know Seattle's high. I know when she goes to Havre, it's low. I mean, but if you've got somebody that travels a lot of funky places, you have to look them up.
And then you have to take half of that?
And it's half that number plus actual lodging. So that's the key. So the other two methods, you have your choice if you're an employee who travels on behalf of work. And basically you can either do the first one, which is just a specified rate per day. It changes every year in the Internal Revenue Code. It's updated for inflation. Or, again, the second one is the high-low method, but it's lodging and everything, and it's easier if you travel a lot, because basically you say everything's considered a low area, $172 a day, unless it's one of the specified high areas, like San Francisco or Seattle or Dallas or LA. And once you choose that method, you've got to use it. Per diem, basically the goal of it is down here in the green type. It's so that I don't need to keep, every time I have a cup of coffee, a record on a business trip. And if I travel a lot, that's just too much. All of the rates are split into a lodging component and a meals component, and always with meals you only get 50%. So these two methods are if you're an employee and you travel on behalf of your job. So I'm a saleswoman, I'm expected to travel, I don't want to keep all my receipts, so I choose one of these two per diem methods. If I'm self-employed, I have to use that last one. Okay. Entertainment. Meals and entertainment are usually just talked about in the same breath. Entertainment is also only 50%. And whatever you do for entertainment has to occur directly before or directly after a business meeting or a conference or some sort of business endeavor.
Oh, it has to be related to it or.
Yes. So like, I mean, when I used to travel for business, when I was the controller of a pharmaceutical firm, we did bovine and equine pharmaceuticals, and a lot of that's in Kansas City, which is a super exciting place to travel. But you go and you have dinner, and then say, they want to go to the Greyhound races, or they want to go to the casino, or they want to go do something. It's got to be right before or after a business meeting to be directly related. And then you've got to take your receipt, and you've got to kind of document on it, what was the purpose of the business meeting? Well, I was there to, network with distributors, for example, or, find a manufacturer, or whatever I was doing there. Then you would put that on your receipt. That's about all I have to say about that. It can't be extravagant. It's got to be ordinary and necessary. Again, that has a ton of meanings depending upon what world you're in. I mean, believe me, when you're dealing with ranchers and cattlemen, you've got a whole different meaning than when you're going to New York City trying to get venture capital from people. What's ordinary and necessary to do business. So it's a very vague term. Education. Okay. So education, like the intro up here says, this is a very complex area, which it is. There's continuing education. There's education, which continuing education is I have a job and I'm continuing to get more education to keep my job or enhance my skills, whatever. Or I'm self-employed and I'm trying to continue my education to enhance my skills. Versus going to school to get educated to enter the job market. This, because we're talking about business expenses, is this screen is treating you as if you're employed or self-employed. In other words, you're trying to enhance your current skill set. So the question is, what's deductible? So this is me going to my conference I'm going to in New York City in March. Is it a write-off? Well, let's look. What's deductible? Well, the first thing you have to do when you travel for usually to some sort of course or workshop or conference is you've got to pay a fee to get into the course. So this is a 2-day course on sustainable business, and it's $1,095 to sign up for the conference. So that's deductible. They tell me that right here. I've got to pay to stay somewhere, obviously, so my lodging costs are a write-off. I'm going to need to eat while I'm there. 50% of the cost of my meals are write-off. And my, I think it's $500 plane ticket is a write-off if it's primarily to obtain qualifying education. Well, here's the caveat. While I'm there, my son lives in Washington, D.C., and it happens right the weekend after spring break. So I'm going to go early so I can hang out with my kiddo before I go to the conference. Do I have to split up my plane ticket? No. What about the money I spend when I'm in D.C.? Do I get to write that off? No. What about getting from D.C. to Washington on the train? $100 train ticket. Do I get to write that off? No, because honestly, if I was just going for the conference, I wouldn't be flying into D.C. and out of New York. I would just be going into New York and staying there, right? Okay, now, here's the caveat. All of this is predicated on the second bullet here. It must be paid to meet requirements of the taxpayer's employer, or to comply with laws and regulations, or to maintain and improve existing skills. But it can't lead me to be qualified in a new trade or business. So in the example I'm giving you, actually, it meets all three of those. We're required to do scholarship as part of our assessment as professors. Scholarship meaning continue to stay current in your field. So it really is to meet the requirements of my employer. Complying with laws and regulations, I can't keep my CPA certificate unless I get 40 hours a year of continuing ed. And this qualifies as that. And also, obviously, it maintains existing skills or improves existing skills. The key here is, you guys, what if I was going to a conference to, because I'm considering going to law school and I want to spend a weekend or I want to spend a couple days learning about international law, tariff law. Would I be able to write any of that off? No, because it would be leading me to a new trade or business as an attorney. So it's not a write-off. So you've got to be really clear. That's really the caveat, is that second bullet. So this is an example of Roberta. She's a paralegal, and she goes to law school at night. Are her educational expenses deductible? Yes or no?
No.
Why?
Because a law school would lead to a new form of employment.
Yeah, paralegal and attorney are the same thing, are they? Same field, but definitely would qualify her for a new trade or business. So she wouldn't get to write that off. Second situation, what if she flew from her home in El Paso to a continuing education conference for paralegals in Dallas, and 30 hours a year of continuing ed is required for paralegals to maintain their certification in Texas? Yeah, then she would get it. She'd get her plane ticket, she'd get her lodging, she'd get the cost of the conference, and she'd get half her meals and entertainment. Okay, so that's the differentiation. Okay, this has gone away, so never mind. For a long time, if you were a teacher at K through 12, you could take up to $250 for supplies that you buy for your classroom out of pocket, but that is just, that's no longer in tax law. That's gone away. Oh, remember we talked about that with that very first gal? Okay, dues, subscriptions, and publications. Again, these are business expenses. For myself, I have to pay, God, I don't even know, something like $400 a year to keep my state license current and my membership with the American Institute of CPAs current. So those are dues. I get to write those off. Subscriptions, anything that I subscribe to that helps my, with my professional development, is a write-off. So publications, so journals, digital journals, access to, I have like, I've got a couple physical therapists, and they get current publications, and they also get these digital downloads that show manipulations, and all that's a write-off for them because it's a part of their professional mandate. And then the last saying says, dues paid to civic or public organizations, you know, the Kiwanis and the Rotary and the Lions and the Elks and all those guys, are only deductible if the club does significant service work. So those are basically the rules around dues, subscriptions, and publications. And you can take those as an employee. I guess I should make that point. Maybe we should take a look at our book. You can take these as an employee or as a self-employed. So let's just kind of flip to the back and see if we can find a Schedule A and a Schedule C. So D-13, we have an A. And D-15, we have a C. So where would it go if I am a medical transcriptionist? I work for Community Hospital, and I pay to belong to a transcription service that helps with, you know, helps me with my work, but I'm an employee at Community. Is that going to go on my A or my C?
Would it be A21, unreimbursed employee expenses?
Yeah, it's got to go on a Schedule A as an itemized deduction because I'm not self-employed, am I? So that's the first question. Second question, where does it go? It goes on line 21, unreimbursed employee expenses, job travel, union dues, education, etc. Attach Form 2106 if required. Now, let's go see if we can find a 2106, which may or may not be easy to do back here. We might need to go to the chapter. Yeah, probably gonna need to do that. So, there should be a 2106 in chapter 3. Page. I guess I don't see one. Well, at any rate, a 2106 is a form that you complete if you're employed and you've got expenses that you want to write off. And I will show you one in just a moment. If you're an employee, or if you're self-employed, it's going to go on a Schedule C. And there is no specific line that I can see that says dues and subscriptions. So it's going to go in the field that says other, which is line 27A on your Schedule C. So anything that doesn't have a direct description, and you'll just kind of have to get a feel for this, is going to go on line 27A. Okay. Clothing and uniforms. If I have something that I need to wear to work, like scrubs or safety shoes, or I have to dress a certain way, I can write them off, but the key here is it can't be something you wear outside of work. So I'm a bond trader on Wall Street. I'm expected to wear a Gucci suit, but I can wear that outside of work. So I can't write that off because it's a transferable piece of clothing versus scrubs you don't wear when you're not working. You always get your protective wear, and any laundering of your uniforms is deductible as well. So I don't know. The only people that I ever have that do this are medical people. Business gifts are very, very tightly regulated. Business gifts are a part of doing business. If you guys were all my clients and it's Christmas, maybe I want to send you all, a fruit basket or a bottle of wine or whatever. That's fine. I can write that off as a business expense, but only up to $25 per donee per year. So if I send you a $60 bottle of wine and fruit basket, great, but I can only write off $25 of it. They're not saying I can't do it. I just can only write it off. Plus the cost of wrapping and shipping, and the husband and wife are considered one donee, so I can't double that amount unless you're both my clients. We've already talked about this before, the deduction for tangible non-cash personal property. Up to $400 is okay for employees for safety or length of service, and up to $1,600 if I've got a qualified plan. And you can never write off the cost of gifts to your supervisor. This is just saying what you have to have as far as written proof, amount, time and place, date and description, business purpose, business relationship. These are the things I was telling you write on the back of the receipt. And of course, none of it ever matters unless you get audited. But if you're audited, you want your paper trail pretty much together. Okay, bad debts. This is sort of an interesting area. First off, let me just say, bad debts is a non-issue if you're a cash basis taxpayer. So we do business together. You bring in your dog, and I, clip and bathe and fluff and puff your dog. And you come to pick her up, and you're like, you give me a check, and the check bounces. Or you said, oh, I don't get paid till next week. Can I pop a check in the mail? And you don't. Do I have a write-off for a bad debt if I'm cash basis? I mean, it feels like you should, right? Because you did the work, and you used your shampoo and your electricity for your blow dryer and all that stuff, right? But you never recorded the revenue because you're cash basis. So you can't write a bad debt off against revenue that you never recorded. So you're basically out your time and you're out the cost of the supplies, but you don't have a bad debt in the sense of having a bad debt write-off on your tax return because you never recorded the revenue. So bad debt expense is only applicable to accrual-based taxpayers. So if I sell you, I'm a printer and you've got a big church in Houston and I do all your brochures for pamphlets for every Sunday, and I get to the end of the month and I do my accrual-based accounting, and I debit AR and credit revenue, printing revenue, and then you default and you don't pay me, then I've got a bad debt write-off. It goes against the revenue, right? But you can't write off a bad debt if you haven't recorded the revenue first. There's basically two kinds of bad debts. There's business bad debts and non-business bad debts. Business bad debts are what I just talked about. It's an ordinary deduction, and it arises to go against the revenue I've recorded. And I can write off as up to the amount of revenue I recorded. Non-business bad debts is different. Non-business bad debts is a friend, my goddaughter comes to me and says, can I borrow $10,000? I want to start a consignment shop for toddlers clothing. Okay, great, here's 10 grand. We sign a note, and she promises to pay me back over 5 years. The business doesn't succeed. She basically says, I'm never going to pay you back, Lisa. I don't have the money. The business never got off the ground. It's never going to happen. I'm not in the business of lending money to people, so it's not a business bad debt to me. It's a non-business bad debt. And now it's capital. A non-business bad debt is a capital transaction. And we know what that means, that I can only write off $3,000 a year until I absorb it all. Right? Remember that limitation, $3 grand a year for capital loss? So I can't just go to my tax return and take 10 grand against my income for this year. I've got to write it off over time, $3,000 a year, because it's a capital loss. And if I get audited, I'm going to need to have something that proves the worthlessness of it. In other words, she writes me a letter and says it's never happening, or I clip something out of the paper that's a bankruptcy notice, or I can show evidence that I went to look for the person and they've moved and left no forwarding address or whatever. You've kind of got to show that you tried to collect and it's never going to happen. So in this example, Keiko is a dentist and she loans her friend Lars 20 grand to start an upholstery business. Subsequently, he can't pay her, repay her. Is this a business or a non-business bad debt? Yeah, non-business. And how long is it going to take her to write this thing off? 6.5 years, seven tax years, isn't it? Because he can only take $3 grand a year capital loss, or she can only take $3 grand a year capital loss. Okay, this is kind of a big topic. This is called OIH, Office in Home. Anybody ever heard of this? People writing off their home office? So this was really abused for a lot of years. So then the IRS really cracked down on it in the, I don't know, maybe early 90s, mid 90s. Basically it says you can't take your home office, so it's a by exception. You can't take home office except for if you meet one of these qualifications. So you can't take it unless A, you use regularly and exclusively as a principal place of business. That's if you're self-employed. if you use it regularly and exclusively as your principal place of business, or if you're an employee, it's for the convenience of the employer and you don't have a regular office somewhere else. So, let's see if we can figure out who these people are. One of my clients is a painter. He's a commercial painter. And he does all of his billing and his bidding and his payroll for his guys and gals out of his home office. So he gets to take a portion of his house as a write-off on his Schedule C against his painting business. How about, I've got an office at home, and forget my tax business. Let's just say that I use that office to grade, to prep for school, to develop, classes. Do I get to write off my home office as a University of Montana employee?
Not if they provided you one.
Right, exactly. Because I've got a regular office. That's lovely that you have a home office, but they've provided you with one here. So you can't write it off in that case. So I can't write my home office off on my Schedule A, but I can write it off on my Schedule C because I use it regularly and exclusively to see my tax clients. So then I do get it. So use regularly and exclusively as principal place of business. Or it's a regular place to manage your business and meet with your clients or patients. So I'm a psychiatrist. I have people come in my home. I'm a social worker. I have people come in my home. I'm a therapist, any of those things. Or if you have a separate structure. So I've got a construction company and they just built a little on their land up Patty Canyon. They just built a small 10 by 15 structure. That's where they manage their business. So I get to write off everything associated with that little building. Or if you have somewhere that you keep inventory. So I've got a client up in St. Ignatius that does herbs and vitamins for women that have been through breast cancer. And they've got a warehouse and it's chock full of herbs and minerals and vitamins. Clearly the cost of that warehouse is all a write-off because it's used solely for inventory storage. So those are really the only 4 cases. There's gross income limitations with office and home. You cannot use office and home to create a net loss unless it's attributable to mortgage, interest, and property taxes. So let's go back and look at a Schedule C again. You need to get Schedule C on page D15. See if you can figure out on the Schedule C where my office and home comes through.
Would there be a couple different spots that could go?
No, there's really only one spot.
Isn't it down by line 30?
It is. It's all the way down on line 30. And where does it tell you that the number comes from? Do you actually do the work on the Schedule C?
You have to do another form.
You do. You have to do an 8829. And that is we'll look at that in a sec. Anyways, let's just, first off, I want to just show you that that's where your office and home goes to. And what that screen was saying that we just looked at is that you can't create a net loss for the business other than the allocable portion of mortgage interest and property taxes. So what does that actually mean? I think I know maybe what's going on here. I think it has something to do with that ink. Sorry. Let's see. Do you see anything that... No. There we go. Now let's see. So this is what's not working, huh?
Did you run on batteries or something?
I don't know the answer to that, Ross. Huh. The heck?
Must be off the binder.
The calibration on the pen was.
Oh, yes. This is really important. Show you. Okay, so let's just do some examples about this, because this is kind of tricky. Okay, so let's just think first if we can come up with some kinds of costs that it costs to run a house that you think might be deductible. Utilities. Good. What else? One more time. Okay, so phone's interesting. You never get your first landline into your house because that's personal. If you have a second line, for example, for a fax machine or something, yeah. Now a cell phone does not go into office and home. That's a business expense, and it goes on your Schedule C, but it's not a part of your office and home.
Insurance?
Absolutely. And if you're a homeowner, it's homeowners. If you're a renter, you get a portion of your renter's insurance if you have it. If you own your house, you've got mortgage interest and property taxes as well. You could also have, yard and garden expenses. Okay, let's just say those are my 5 kinds of expenses. Now, the next thing you have to say is, how big's your house and how big's the square footage of your office? So I'll give it to you and then you do the math and we need to figure out percentages. So let's say my office is 12 by 12 and my house is 2,100 square feet. So figure out what percentage of my house is my office. My office is 12 by 12 and my house is 2,100 square feet. Okay, so what's my office and home? What percentage?
Office is about 0.069.
6.9%. So therefore 93.1 is my personal home, right? So that's the first thing that you have to do.
How did you get that?
So my office was 12 by 12, so 144 square feet divided by 2,100.
Oh.
And I operate my hair salon out of it. And so I'm a Schedule C. And let's see, I gotta do some math in my head real quick here. Okay, so my revenues from my hair salon's 30,000. And my supplies, doesn't matter. My supplies, the people that work for me, my cost of going to hair conferences, blah, 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 is, and my question on this case is, what, if anything, is my OIH write-off? So I've got 30 grand of revenue, 27.9 of expenses. What, if anything, is my OIH write-off? Okay, now let me tell you the rule again, and then I'll let you calculate this. The rule is that office and home cannot throw you into a loss unless the loss comes from these two items. Because these two items are write-offs regardless, right? Where did these two guys get written off, even if I don't have office and home? Where would they go? On my Schedule A, right? So they're saying if you push them over to the C, that's cool. Now, let me just make this point, and then I'll let you do some work. The personal part of utilities, insurance, yard and garden, blah, 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 that's non-deductible. Those are just personal expenses. Where are these two guys going to go? Where's the personal part of my interest and taxes going to go?
My itemized deduction.
Schedule A. Your task is to figure out how much is my office and home deduction? I mean, like the raw number, A, and B, how much, if any, of that do I really get to take? You with me? Huh? Well, it depends. If your interest and taxes throw you into a loss, you're fine. And I don't know if you've got $2,100 over here. You better figure that out.
Yeah, that's fine. If
Yeah.
there is 20.
Yeah. But that's not really just a blanket statement, because if these guys threw you into it, you could take more than 21. They can throw you into a loss
That it can be.
if it's attributable to these two things, because you get those anyways somewhere. So in that example, I get it all, don't I? Add them all up, 871. No big deal. How would that change if I did this? What would my office and home write-off be if I changed the expenses to 29.6? I think I get 565. I get the total of this and this. It's going to throw me into a loss now, isn't it? 30,000 minus 29.6 minus 565. I'm going to have a net loss on my Schedule C.
That's what
Oh, Oh, right, okay, right, so I get a loss from that. All right, so we're gonna have another example on the slides to try. Now that we kind of understand, let's look at this again. So office and home you cannot create a net loss, except for the applicable portion of mortgage interest and property taxes, because these are generally deductible anyways. It doesn't matter whether you take them on your C or your A. The other costs of operating a home, which are included in the home office allocation, include rent, insurance, association dues, repairs, cleaning, gardening, and depreciation on the cost of the home. I forgot to put that up on the list. If I don't get to use my whole office and home, I can carry that forward to subsequent years. In years where I've got enough revenue or enough net income to absorb it. So I don't lose it, I just have to carry it forward. The allocation is done on the basis of square footage. We've done that calculation, home office square footage divided by total home square footage. And there's 2 columns on the 8829. Now we do really need to find an 8829 because this is important. Page, it's got to be one in chapter 3. -59. So the top is where you do the calculation on the percentage of square footage. All right, how much of my house do I use? Divided by how big my house is takes you to line 7, business percentage. Then you'll see below it in part 2, what are the 2 column headings there in the middle? Direct expenses and indirect expenses. And here's the differentiation, and it's really critical that you get the right numbers in the right columns here. If you put something in column A that says direct expense, that's only if you only did it to your home office, not your whole house. So, for example, like down on line 20, I installed an air conditioning that's got its own, bill only in my office. I'm not going to allocate that across my whole house. It all belongs to my home office. Or, what else is a good example? Line 19, I actually did this a couple years ago. I put new windows in my house, but I got to take the whole cost of the window that went in my office. Right? Because it was directly related to my office. Or when you buy cabinets for your office. Versus what goes over on the indirect is something that pertains to the whole house, like line 17, insurance. When I pay for my homeowner's insurance, I don't get to take all of that. I get to take 6.9% of it. What else is probably going to go in the indirect expenses column? Insurance, absolutely. What else? Mortgage interest, absolutely. Rent. I mean, almost everything's going to go in indirect, actually. So, there's two columns. The direct expenses is only for something done directly to the home office because that doesn't get multiplied by the percentage. You get 100% of that. Indirect expenses are applicable to the entire home and allocable to office and home. For example, if I have a cleaning person or homeowner's dues, that applies to the whole house. I'm only going to get 6.9% of that. So, does anybody need further clarification on that? It seems like that's something students really struggle with. So you're going to have very few numbers here. There's also now a new simplified method, which just gives you $5 a square foot, up to a total of $1,500.
So if you just started a business though, and you made your office, better usage than it was before.
Yeah.
Would that be direct expenses?
If you were doing something to the office, yeah, I put some nice carpet in there. I bought a nice couch for my clients to come in and sit down. I put in a microwave and a coffee pot so that, I'm self-contained. All that would be direct expense.
What if you got a special kind of insurance just because your office is on your house?
Well, that's a very good point, and you have to, it's called an umbrella policy, so that if somebody gets hurt, walking up the steps in the ice and falls down, I don't want them to sue me because they're a client coming to see me. You've got something called umbrella insurance, and that goes on your Schedule C.
Okay.
It doesn't go here. Yeah, there's kind of a lot to this. You'll just have to kind of keep asking questions. Really, you only put anything on the office and home if it's directly applicable to your home. The example you just gave was insurance because I'm worried about my liability. So that goes on my Schedule C.
What about like theft or burglary or something? Because it could be your whole house or.
That's my homeowner's insurance, and that goes on. That's going to get allocated.
Okay.
Through my OIH. Are you guys thoroughly confused? Okay, good. Okay, so we've looked at this. If you're self-employed, you do your 8829 and that number carries to line 31. Your software will give you the limits we just calculated. In other words, if your interest and taxes throw you into a loss, they'll give you that. But otherwise, they'll only take you down to 0. You can also take, as we saw, your office and home if you're an employee, but only if it's for the convenience of the employer and you don't have a regular business. Then that's going to flow to your Schedule A on that job, unreimbursed job expenses. I don't think, I've maybe had a handful of employees over the years that have taken OIH. Not many. It's mostly for self-employed. Okay, so let's try an example. We've got a gal named Kitty. She's a part-time cartographer. She maintains an office in her home where she reads electronic maps and keeps her client records. Now, she's got obviously a very big house. $12,000 of allocable mortgage interest goes to her business. Mortgage interest and taxes. And she collects $11,000 in fees. Assuming she has no other business expenses, what is her current year office and home deduction? So she just started her business. She collected $11,000 in fees. Obviously, her home office takes up a big portion of her home, which it would if you're a map reader. How much is her write-off for OIH? $1,000 in the whole, yeah, it takes her, and she gets the whole $12,000. What if she also allocated $2,500 in maintenance and utilities? What would her OIH carry forward be?
And still 1,000, because she couldn't use that to go further in the home, right?
Right, but the question is, what's her OIH carry forward in the first scenario?
Oh, if she only had the 2,500 in maintenance. Well, she'd get the $1,000 plus the 250 50, right?
Okay, not quite. So in the first scenario, the answer is she has no carry forward because she uses it all.
Yeah.
Right? In the second scenario, her carry forward's the $2,500. The taxes and insurance or interest can always throw her into a loss.
Yes.
But she can't absorb this because now she's in a loss. So her carry forward is $2,500. That's her OIH carry forward, and hopefully in the next year she'll be able to absorb that because she just started the business late in the year, like November. So hopefully next year her fees will be able to absorb that carry forward. And that, just FYI, shows up the carry forward. So if you're looking on 3-59, your carry forward comes through, or your carryover is calculated all the way at the bottom.
Is it 34? Oh, 42 and 40 operating expenses.
Yeah, they're trying to get you down to, they're trying to figure out if you're limited or not. So it will give you your number down here essentially that you're carrying over to the next year, and your software remembers that. When you transfer data over, it's going to immediately try and plug that $2,500 against current year income. Okay. It gets much more complicated. I've actually got somebody on line 35, if you look. Allowable expenses for business use of your home. Blah, blah, blah. If your home was used for more than one business, see instructions. Like I've got two different sets of clients, husband and wives that are both self-employed, both operate out of their homes, both have their own home offices. So then you've got a lot of juggling. We're not going to do that. That's a little complicated. We're just going to deal with one person, one office, and home. Okay. NOLs are really pretty complex topic. I'm not really sure why it's even in an intro book. They can only result from business losses, and really the way that they work is if you have net operating losses, you carry them back 20 or back 2 and forward 20, unless you make an irrevocable election to forego the carry back, then you only carry it forward. So what that really means is say that say there's the reason we have NOL laws is I'm taxpayer A and I'm taxpayer B. And let's see, how can I do this? I make $100,000. Okay, so I make obviously $300,000 over 3 taxable years, and I'm going to pay, my marginal tax rates on this income, right? Versus I'm somebody that's just starting out a business, and I take a $150,000 loss. Okay. What's the situation? How much am I going to have taxable after 3 years for A? How much have I earned after 3 years? $300,000. How about B? How much has B earned after 3 years? $300,000. In the first case, so we can agree that they've had an equivalent outcome in 3 years of earnings, right? How much is taxable for A? $300,000. Without NOL laws, you don't get any benefit from these 2 years, and then you pay tax on $500 in the 3rd year. See what I'm saying? Without the benefit of NOL laws, So that's not fair. They've had the same situation after 3 years. That's why we have NOL laws. NOL says, when you generate a loss, like I'm starting out my business here, yeah, it's going to take me a while to get out of the chute. When you start up a business and you generate an NOL, you have two choices. You can go back 2 years, in other words, amend prior year tax returns and take this loss against them. Oh, that might be beneficial. I don't know, I haven't given you enough information. But let's say, no, before this I was a student, I don't have any income to take. So I irrevocably elect to forego the carryback. In other words, I don't want to go back 2 years. I want to take my loss forward 20 years. So I make that election. So what does that do for me in 2015? That doesn't do anything for me in 2015, does it? Other than increase my loss. So now what do? Now I pull it all forward to 2016. And I take my NOL here and I pay tax on 300. And now this is fair. You with me?
Are there limits on how much you can take it all, or could you, let's say I only want to take
Oh,
$100,000.
you've got to absorb as much as you can in the subsequent years.
Okay.
You are not going to be responsible for doing NOLs. They are really kind of a bitch. There's a lot of adjustments to them, and it's also different between Montana and the feds, so you have these adjustment worksheets that are just a pain. I think right now I've got one client that I'm still carrying forward some NOLs just from that situation from a startup business. You're not going to be responsible for doing them or calculating them, but I want you to kind of understand why we have the law.
So you have up to 20 years to divide it up, but you don't have to wait 20 years like the other one.
You have to absorb as much as you can. In this case, I couldn't have said, oh, I only want to absorb 10 and carried the other 190 forward. I've got to take the full 200 because I can.
So if you had a huge loss, let's say you had $1 million, you could only absorb the 500.
Yeah, take it down to 0.
And then carry forward whatever future income would be.
Exactly. And for people that have really complex business situations, these aren't my clients for sure, but you have numerous businesses and you're playing the game of trying to take NOLs from one against the other. I mean, that's not my world, but it's a world. Okay. And again, if you don't want to go back those 2 years, like I don't have any income in those 2 years to take it against, or I really think this business is going to hit and my tax rate's going to be really high in subsequent years, I want to take my loss against big marginal tax bracket years, not against little tax bracket years. So I'm going to do this, and it's just like a check the box thing. I don't want to go back 2 years. I want to take it all forward. Hobby losses. This is a point of contention with a couple of my clients. So one of them is a videographer, and he shoots film for people, and he charges them, and he's got this massive basement full of unbelievably expensive equipment, and he comes to me every year, and he's like, I billed out $8,000, and I bought $30,000 worth of equipment. Year after year after year. He's got a very expensive hobby, which is great, have at it if that's what you want to do, but it's not a business. And the reason it's not a business is he's not showing a profit in 3 out of 5 prior years. Sometimes, some years, if he doesn't have a lot of purchases and he gets like a really good client, he might eke out like $1,000 profit or something. But and I track all that. Every time I open his file, I've got the last 5 years. Because I know that we're going to have this conversation. And I can just show it to him. Look, in 2012 you lost $12,000. In 2013 you lost $10,000. In 2014 you made $500. In 2015 you lost, and you can just see it in black and white. And then I have to remind him, you've got a hobby, Nick. Oh, cranky. Okay, but that's just how it is. He can deduct his hobby expenses, but only up to his hobby income, which just nets you to zero. So you got $8,000 in fees, spent 30 grand on equipment, got zero impact on your tax return. Also, I've got some folks that do this. My other people that I have this issue with are my musicians. And of course they travel and they buy all sorts of expensive stuff and they've got to stay where they go. And then they get, $300 for the band to split, for a gig. It's like, that's great, but you can't write off your new $9,000 drum kit, for playing up in Big Fork 3 nights. The law changes if it has to do with horses. This was a powerful horse racing lobby. If you take your horses around on the circuit, you've got to show a profit in 2 out of 7 years. So it's less onerous to show if you're a horse person.
That's only horse racing, or does that have to do with it?
Anything, showing horses, racing horses, studding out horses, anything like that. You've got to show profit in 2 out of 7 years. And the IRS does keep a pretty keen eye on this because it's pretty abused, or can be. I had a gal come, this is sort of an interesting story, family friend, of course I had no idea what their tax situation was. He's a doc and she was a interior decorator and, okay, great. And I had no idea how her business did. I mean, she had a little shop downtown and I assumed it did fine, whatever. And then she got a letter from the Montana Department of Revenue. He's got quite a nice W-2 being a doctor. And she had these $20,000 and $30,000 and $40,000 a year write-offs on her Schedule C as a loss in her home interior business. And of course, the state came back and said, I'm disallowing these losses and assessing tax on it for the last 5 years. I mean, it was a chunk of change. It was 6 figures. And she came to me, and this isn't right. This can't be right. And I mean, I sat looking at it, and I said, you're not going to want to hear this. But you're losing $30,000 a year. That is not a business when you're doing that year after year after year. The only reason you can do that is because your partner, has got a very fine W-2. None of us could live like that. That wouldn't be a business, right? So we did have to restate all of her tax returns and remove that because it was a hobby.
Was she doing them herself, or just the person doing them?
TurboTax. Which is what is so dangerous. You don't know the tax law. It tells you put in all this stuff.
Yeah.
And you put in all this stuff. This is my business. This is what I do. But it doesn't track 3 of the last 5 years or 2 of the last 7 if it's horses. That's the problem with those programs. It doesn't know tax law.
Yeah, it should.
Yeah, but for $19, you are not paying somebody to interpret 1 million pages of tax
I
code.
just don't know why her husband was a doctor, why she would just do it herself.
Yeah,
Taxes herself.
right. Oh, I see what you're saying. Yeah. Some people love to do it. I also have a number of clients that they want to. I mean, some of it's saving money, but some of it's just being interested in it. My organic farmers, for example, her original degree was in statistics from Dartmouth, and she's a flower farmer, organic farmer. She does all her books, everything, her Schedule F for farm, and then brings it to me to put into the software. She likes I think she likes to feel comfortable that it's gone through the software process. But it does cut her tax bill down by a good $500, and she enjoys it. So, at any rate, you have to deal, like some people are like, they're terrified of it and they just bring it all and shove it at you and they don't want to see it and they barely want to sign it or touch it. They're just terrified of it. So, people all over the place. The end. Okay. Let me shut this down and we're going to talk about, yeah.